What I will talk about today is about the experience that I've had while I was working on Mauritania and looked at the monetary transmission mechanism a bit more closely. So to give you an idea what happened during 2010 and 2011 is you saw two things. So you have the blue bars right here, which show the free reserves of the commercial banks. Free reserves are essentially the deposits that commercial banks have at the central bank, so their means of payment. And you see that they've been skyrocketing, so really going to levels that Mauritania had never seen before. At the same time, the blue line shows you credit growth, a growth in credit to the private sector. And at the same time, that actually has been going down. And so we looked at these two developments and we were thinking, wow, this is strange, because if banks are much more liquid, you would also actually expect that they start lending much more. So what exactly had happened in Mauritania that bank reserves, so the deposits of commercial banks at the central bank, started increasing so rapidly? So essentially, they were the byproduct of massive accumulation of foreign exchange reserves. So what happened in Mauritania in 2010 and 2011 is that they had a positive terms of trade shock. So all of a sudden, the prices of their main export commodity, iron ore, went through the roof. And then the central bank was able to buy lots of the incoming foreign exchange. And then the byproduct on the liability side of the central bank is the creation of liquidity. So that's why you see this actually quite sharp correlation between the asset side of the central bank, so foreign exchange, and the liability side, the deposits of commercial banks. Okay. But of course, banks can not only lend to the private sector, so you may be saying, okay, just for the fact that the commercial banks have not lent more to the private sector, maybe they did some other stuff with this additional liquidity that was created. And actually, in Mauritania, it happens to be the case that we actually only have three main categories of credit. So banks in Mauritania are not particularly active. So what they do, they lend to the private sector, usually to a narrow range of customers. They also finance short-term credit transactions via letters of credit, and they also lend to the government. So what I actually will be doing is I will look whether there's any significant effect between monetary policy, and what I mean by that I'll come to in a second, and these three credit categories. So now what my paper is really mainly about is to be careful to say what is a monetary policy shock. Because, of course, just looking at the correlations between bank reserves and credit may not really tell you all that much, because there may be unobserved stuff that's happening at the same time, and that may be affecting both banking sector liquidity and credit. So what I want to do is be careful and really be specific about when we can talk about exogeneity, when we can talk about an exogenous monetary policy shock. And it just so happens that Mauritania has a nice institutional setup that allows me to identify these shocks. So first of all, the first step, I want to be clear, am I actually looking at the right monetary or indicator of monetary policy? Because when we want to say, okay, monetary policy loosened or it tightened, what is the indicator that we look at? Bernanke-Mioff have a very nice QJE paper where they actually go rigorously through that step for the United States. In Mauritania, it happens that I don't have to do that because out of all the possible indicators that there are, so the policy rate, T-bill rate, interbank rate, for various reasons, none of them work, and I go through that in a bit more detail in the paper. So the indicator that I'm left with is bank reserves, so the deposits of commercial banks at the central bank. And now, so this is the first step. I say, okay, this is the indicator of monetary policy I want to look at. The second step is that this indicator actually fluctuates with external developments in Mauritania. We already saw that in the first slide, where bank reserves went through the roof because iron ore prices had been increasing. So on this slide, I just want to briefly illustrate the idea that in 2009, when iron ore prices actually came down sharply during the global crisis, you see that you had an attempt of the central bank to do some type of stimulus. So all of a sudden, bank reserves started to increase. But the important point is that they were actually not able to sustain that stimulus. And so as long as the external environment is not favorable in Mauritania, it actually means that there is no real independent conduct of monetary policy, but it actually all depends on what's happening on the external front. And that is precisely the mechanism that I'm exploiting in my paper. So the external development that I'm looking at are the export of fish products. So Mauritania mainly exports iron ore, but a small section are exports of fish. And the nice thing about the exports of fish is that they are largely exogenous to the rest of the Mauritanian economy. And that is my key identifying assumption. And of course, I mean, everybody is free to criticize whether this assumption is valid or not, but there are good reasons why you would think that like fish exports will be relatively exogenous to the Mauritanian economy. So because they depend primarily on fish prices, which are international, and on fish catches, which are also relatively random. So the fleet of Mauritanian fisher boats, they go out, and so then they cast their net, they sort of get their fish captures. On a good day, they catch a bit more, on a bad day, they catch a bit less. Anyway, but this is relatively random. So now the crucial institutional characteristic that I'm exploiting is that the export receipts from these fish exports actually have to be repatriated to Mauritania. So the banks that are responsible for managing these fish export receipts, they cannot keep them abroad, but they actually have to bring them back. And so mechanically, when fish exports are high, these banks that are responsible for executing these transactions will also see a contemporaneous surge in their deposits at the central bank. And that is just purely mechanistic. And so I'm saying, I'm looking at these episodes when the deposits of commercial banks at the central bank increase because of fish export, and I use this as my exogenous measure of a change in monetary policy. Here on this slide, you can just see that there is indeed a positive correlation between fish exports, which is on the x-axis, and bank reserves on the y-axis. So this is my crucial identifying strategy. And now I'm going to show you what happens when we run with this assumption. Just briefly, a brief word on the data. So I've had for 6 years monthly balance sheet data for 6 Mauritanian banks where I know that they have relationships with the fishing industry. So I'm not looking at any spurious type of relationship, but I know these banks. Then the data on fish exports comes from Eurostat. Eurostat has also monthly data on Mauritanian exports to the EU for just fishery products. And at the same time, to introduce variation across banks, I actually compute market shares that the banks had in selling foreign exchange receipts in the official foreign exchange market. That data came from the Central Bank of Mauritania, to whom I'm also very grateful for actually having shared this data, because this is confidential stuff. Okay, so I actually then I use 2 strategies, or I use 2 empirical methods to look at whether there is a significant relationship between exogenous monetary policy shocks and subsequent lending by banks. So first I run bank by bank structural vector autoregressions. So I use so I have fish exports, I have bank reserves, and I have bank lending here in this y vector. And actually I run 18 of these VARs. 18 because I have 6 banks, and I look at these 3 types of credit, right? I look at private sector credit, I look at government credit, and I look at these short-term trade finance type transactions. And my crucial identifying assumption, which I've already explained, but here we can look at it a bit more carefully. It looks a bit like Choletsky decomposition, but in fact it's not Choletsky, because you can see, especially in this A matrix, so I let bank reserves depend on everything, on fish exports and on credit, but credit, on the other hand, does not depend on fish exports. That is, the reason why I say that is because I say fish exports are largely exogenous to the rest of the Mauritanian economy. It also happens to be the case that the fishing industry borrows very little from Mauritanian banks. Like in the share of the total loan portfolio, it varied between 10 and 5%. So it's not a large share. So this is what my identifying assumption looks like. And here are now the impulse response functions. And you can see that they are mostly flat. Actually, I look here at the, so this is the impact of a shock of fish export on reserves, which in my identifying assumption should go up. In this bank, it doesn't happen. In this bank, for example, it does. So I'm aware that I mean, it should look a bit more beautiful than that. Unfortunately, it doesn't. But for the impact on credit, and here I'm looking at private sector credit, but the impulse response functions look the same for government and for trade credit. They're totally flat. So I find no effect of monetary policy shocks on lending. My second strategy is that instead of the bank-by-bank VARs, I just use two-stage least square panels. And I just changed the data frequency because otherwise you have too much noise in the month-by-month data. So now here I look at quarterly data. But the crucial thing is that in my first stage, that I use these bank-specific fish exports, and I regress that on the reserves that that particular bank has at the central bank, and then I use only this predicted value of reserves in the credit equations. And I'm actually, and then I mean you can see like there's a few more controls in there. And these are the results. So the results show again that there's no significant impact on any type of credit, and that again holds for all for the three categories. But what I really want to draw your attention to are these under-identification tests, because really this is what my entire paper relies on. And actually these identification tests look quite beautiful in the sense that they always reject under-identification at like very significant levels. So you can hear this is 2%, this is 1%. So what these statistics tell me that in fact the stuff that I'm estimating is well identified. So that these bank-specific fish exports are a good instrument for reserves. My benchmark specification are exactly identified, so I can't really test the exclusion restriction, but when I sort of use the square of fish exports and then run like a Hansen test, it also tells me that in fact that the fish exports don't belong in any of the credit equations. So if you now believe me that in Mauritania monetary policy is not effective in affecting banks' lending decisions, then we can think about why should that be the case. And it just so happens that in Mauritania, as in many other sub-Saharan economies, we have actually one crucial characteristic that really makes these banks different from banks in advanced countries is they have extremely high loan concentration ratios. So what that means, these banks lend pretty much to 10 guys, and they know these 10 guys extremely well. Usually they also belong to some affiliated company. So it is not really the case that banks' lending decisions depend on on how liquid the bank tends to find itself at a particular moment. It's more the case, okay, we know our 10 customers, we lend to them, but if these 10 customers are satisfied, if monetary conditions loosen, actually I will just accumulate the additional liquidity. I will not use it to lend to unknown customers because this is too risky. It's too risky, but also in Mauritania what happened to be the case is that the regulator had actually specific regulations in place that allowed banks to have these high concentration ratios. And that's something that's when I was on the Mauritania team, this is something that we discussed with the authorities in great detail because we wanted to tell them that not only does it preclude financial access for the wider part of the population, but it fundamentally, the high loan concentration ratios fundamentally also undermine the transmission mechanism of monetary policy. And there's a very nice paper by one of my colleagues at the IMF who talks in this context about lazy banks. So that's, I think, a very catchy term that characterizes a bit the behavior of these banks. And yes, and so this brings me now to the end. So what I'm basically saying is that monetary policy in Mauritania is relatively ineffective. And that is actually very much in line with what our colleagues at the fund have been finding. They looked at the emerging literature on this topic, and they also basically come away with the conclusion that you can't have much faith in monetary policy as being used as a counter-cyclical tool in low-income countries. What I've done in my paper, really the main thing is that I've been a bit more careful about identifying these exogenous monetary policy shocks. Because, everything that you do about monetary policy effectiveness is only as good as really the identifying assumptions that you have underpinning your empirical strategy. And Yeah, and I think given certain characteristics in other low-income countries, this is actually a strategy that may be useful to be exploited, yes, in other countries as well. So, and with that, just thanks a lot again for coming, and I'm now passing over to the discussant. So thank you.
I wish to use the microphone. Thank you, Robert, for that wonderful presentation. I must admit, I enjoyed reading your paper. It is very innovative, and you captured the most important issues in monetary policy transmission mechanism. I like the way you approached the exogenous factor, how you identified fish exports. That was well elaborated. However, my concern was on the monetary policy stance, the indicator of monetary policy stance in Mauritania. I was quite disappointed to find that their interbank market is not working well, and also their policy rate is not working well. And when you look at most of their policy documents, they front the policy rate as their monetary policy indicator. I was just wondering, reserves and monetary aggregates. Don't you think the new innovations in the financial sector in Mauritania, like I read somewhere, could impact the reliability of that monetary policy indicator? Maybe we need to look at that. And also, I was wondering about the ineffectiveness of the bank lending channel in Mauritania. Could it be more due to structural factors in the banking industry? Maybe we need to learn more about the structure of this financial sector. How is it distributed? How are these banks? Yes, you talked about concentration. What is the distribution between big and small banks? Could it be because the 6 banks you looked at that deal with fish exports and repatriation exports, receipts, to me they seemed like big banks because they contribute about 75% of their asset portfolio. So maybe, like you indicated somewhere, that these banks with high concentration and actually big banks, they are less sensitive to monetary policy shocks. Could that be the reason? Could we also have like a control variable for small banks and see how they behave if we compare the 2 categories of banks? Thank you, Robert.
Sorry. Can you just maybe say something more about the banking system, just to make it into a context? Are these local national banks or foreign banks, or because clearly that could make a difference in terms of reaction, since you say that they have this bunch of clients they know, customers they know. So it's and also on the model, I'm not clear to me how you can take into account the demand side. So you're actually, because you're looking at shock on the supply side, and you're actually assuming that there will be a demand for credit. Yeah, I'm not sure that's necessarily be the case.
Sorry, I walked in a bit late, so I may have missed this. Could you please clarify on the data time frame that you use when you talked about the monthly data? Because it might give us an idea of structural breaks that happened between, if there were any structural breaks between that time frame that you could account for, or some sort of reforms that could explain why the interest rate channels basically don't matter in this case. Thank you.
Okay.
Hi, I wonder if you could elaborate a little on the first stage regressions. I mean, I was concerned that in the ones you showed, there was no effect. I mean, isn't it a condition for an instrument that the shock effect, you know, you have a sufficient power in the instrument to explain variation in the first stage? And maybe you referenced that when you were talking about the underinstrumenting problem, but I'd be worried about weak instruments in this case. And then I wonder also, you briefly mentioned monetary policies being passive. If these shocks are small, you know, and they're even a little bit non-passive, isn't it possible that they were kind of thinking about their, you know, they could easily undo the effects of these shocks on the system if they want, right? Without barely trying. That's why I was curious about how you see the reaction.
Okay, you can respond? Okay. Okay, there's one here. Okay, yeah. Okay, for the benefit of others.
It was just following up on this reaction function. I don't know enough about Mauritania and the institutional structure, but whose reaction function? So this is CFA zone, or is it outside zone?
No,
this is outside zone, right? So it's... Okay, fine. I'll not pass my question any further.
Okay, respond. You can respond.
Yes, okay, so first of all, there was a structure, you wondered about the structure of the banking sector. And so Mauritania in the early 1990s went through like sort of privatization, where sort of lots of the sort of formerly state-owned banks were all privatized. And it just happens that they went into the 5-6 business conglomerates, which are usually affiliated with particular families. And so most of the banks in my sample are these national, domestic national banks that sort of have had long-standing business relationships with particular conglomerates, which include the fishing industry. Interestingly, though, there's also one foreign bank in my sample, and it turns out that they bought. So one French bank bought a domestic bank, but when you then look at their the behavior of how their loan portfolio changed over the time that the French bank was in charge, it actually did not change. So, in some sense, you can also rationalize that because lending to people that are not affiliated with your... Just we can't hear you. Okay. Should it be, is it better now? Or? No, it's not. No? Thank you very much. I'll deal with that in a minute. Okay. I'll do that here. Yeah, and it's actually not surprising, or like it is not surprising that even like a foreign bank that comes in is not able to dramatically expand like the portfolio of its clients, just because if you have very little information about your potential borrowers and you have no way of enforcing contracts, then it is just very, very risky. So actually, so in this case, the one data point that I have of one foreign-owned bank, it didn't change like sort of the way they were acting in the Mauritanian market. So then, in the other side, the other question was about sort of about controlling for the demand side. And of course, I mean, when you look at credit outcomes, it's always the interplay between supply and demand. However, because my identifying assumption is that the monetary policy stance changes for purely exogenous reasons. So if you look then at sort of all these episodes where sort of fish exports change, then bank liquidity changes, on average, domestic demand conditions should on average not have changed in any systematic way with these shocks. So that is precisely my identifying assumption. And yes, and I think, and I motivated in the paper a bit more carefully, but I'm saying, but fish exports really are unlikely to have a systematic effect on other parts of the Mauritanian economy. Then there was something about the time frame. So what I look at is 2006 to October 2011. So I have, okay. I have monthly data, and yes, during that time period, I mean the one big structure. I mean Mauritania went through lots of political turmoil in that period. So in both in the vector autoregressions and in the panel, I have a dummy to account for the coup d'etat in 2008, which then also led to which also coincided with sort of the Lehman crisis and then the beginning of 2009, where things were really going quite badly. But other than that, I cannot think of a particular moment in that time, or during my sample period, where I would a priori have expected to be there a structural change. So this one particular moment, I have a dummy for that in my model, but other than that, I'm not sure. Unfortunately, then the time period is really not long enough that you could really test formally for structural breaks, just because you don't really have enough observations. But if I had more, then this is certainly something that I should be doing. Yes, about weak instruments. Yes, I think maybe that's exactly what I was worried about. And when you look at the impulse response functions of the vector autoregressions, they don't look particularly convincing, and I'm aware of that, because usually, even if you have a positive response of reserves after a shock to fish exports, normally this response is not significant. That's why I actually then started looking at these panel models a bit more carefully, and I was not clear enough or careful enough. These statistics that I show at the bottom of the panel, they're exactly like they're weak instrument tests. So basically they're weak and sort of invalid instruments tests. So there's the Kleibergen-Parp, and then there's the Angrisch-Pischke, which sort of actually then allow you to identify or to see whether any of your instrument or any of the first stage equations that you're estimating, whether they potentially are not identified. And well, the reason why I then became a bit more convinced that what I'm estimating actually has some sense is because these identifications or the null hypothesis of under-identification is actually strongly rejected for basically all these various models that I'm estimating. So that's why I have then in these panel models, I have the sort of the economic intuition that should tell me, okay, there should be this mechanism at the same time, and then the empirics or the data actually confirms that. However, what you're saying is that the shocks from these fish exports tend to be relatively small. That is correct. However, when you look at sort of larger shocks, then your exogeneity assumption becomes a lot weaker. So that's why it's a bit of a trade-off in that sense. I mean, I agree with you that small shocks, it's true that the banks could just, if it is like a small, like sort of positive impact, say, on their holdings of bank reserves, then maybe they don't have a strong incentive to really change their lending behavior in response to that, just because on a magnitude level, it is relatively small. However, I think if you look at such a long time period, if there was some type of relationship, I would hope that the data picks it up. What you're saying, I worried about it too, but yes, I can't now give you like a sort of 100% foolproof reason why I think that this worry is misplaced. I just say that sort of under the strategy that I've adopted, yeah, the data doesn't show it. I would, if there was a significant relationship, I would have expected the data to pick it up. And I mean, and then on top of it, because of these particular features in the banking sector, I find it totally rational for the banks not to change their lending behavior if there is a positive monetary policy shocks, or if there is a positive monetary policy shock. And in addition, what Peter Montiel and Peter Mishra did at the fund, like with their big survey of where they looked at the transmission mechanism in low-income countries, they basically, so it chimes in very well with these prior results.
Thank you. Thank you. Let's listen to the second presenter. That's you. Hello? You're using that?
Yes.
Forward your presentation.
You ought to have done this before this.
But
I'm going to talk about discuss our findings on the bank lending channel of monetary policy transmission in Uganda, and we looked at the bank level data, individual banks. Yeah, the behavior of the individual banks is very important in monetary transmission mechanism, particularly for the credit channel. And for the credit channel, we have two aspects of it. One is the balance sheet channel and the bank lending channel. The balance sheet channel is more on the demand side. It depends on the balance sheets of the demand of the customers for these individual banks. But the bank lending channel seems to be more direct from a monetary policy shock, and it transmits through the supply of loans in the economy. Bank lending, like we know in literature, is important for growth, as stated in the literature. And a brief overview of how this channel works. For instance, in case of a tight monetary policy, a shock to monetary policy, a positive shock, will drain reserves from the banking system. So banks will not have enough to lend out to the public. So people will not invest, and hence economic growth will fall. It will be affected adversely. But we've come to appreciate that this behavior of banks matters a lot in this response to monetary policy shocks. Big banks tend to be less sensitive to these shocks compared to small banks. Why? Because big banks tend to have enough capital, enough liquidity, enough assets. So they will not be so vulnerable to shocks in monetary policy compared to small banks who have to rely on the central bank to acquire loans. So our main question is whether this channel exists in Uganda. A brief overview of Uganda's financial system. It's mainly dominated by the formal financial system, which contributes about 80% of its total assets within the whole financial system. To date, we have about 25 commercial banks, 3 credit institutions, and 4 microfinance deposit-taking institutions. So commercial banks dominate the formal financial system in Uganda. However, we still have the challenge of the market is highly concentrated, with big banks and mainly foreign banks dominating the asset portfolio. Yes, like I stated earlier, this has got implications on competition in the system. If I talk briefly about the monetary policy framework in Uganda, before June 2011, we implemented the reserve money program, and the monetary base was our monetary policy targets. However, due to developments in the financial sector, mobile money services, ATM, use of ATM machines, credit cards, there was instability in the money multiplier. So we could not really measure we could not estimate the money demand function for Uganda due to those instabilities. So we resorted to the IT framework, the IT light framework, where we target inflation rate. The IT framework has been successful in pulling down inflation from about 30.5% in 2011 to about 6.7%. However, when you look at that graph, the lending rate still remains sticky. It is sticky upwards. It does not follow the trend of the other rates. the treasury bill rates, and also the policy rate, the CBR. Similarly, when you look at the private sector credit, it still remains low, and actually it was negative in 2012. So we are wondering whether there are issues to do with this channel of monetary policy transmission. What could be the challenge? Does it exist at all? According to literature, like we all know, a tight monetary policy results into a fall in bank loans, in supply of loans, and hence growth. This has been widely researched. Another interesting paper by Walker in 2012, he identifies this issue of capitalization and the relationship between big and small banks. He finds that well-capitalized banks, less well-capitalized banks and small banks are more sensitive to monetary policy shocks than big banks, because these small banks entirely depend on the central bank, on borrowing from the central bank, which may not be the case for large banks because they may have other sources of finances. The estimation procedure, we derived a bank loan supply model, and in our derivation, we discovered that this model depends on the loan demand, the monetary policy stance, and the bank-specific characteristics, whereby the loan demand is mainly driven by the macroeconomic factors of an economy, say inflation, economic activity, and the monetary policy stance. We compiled data for 20 commercial banks, and we developed an unbalanced panel because some banks were not operational during that period of survey. And for the individual bank characteristics, we specifically looked at the size, the liquidity, and the capitalization of each bank studied, whereby we defined size as the total assets of a given commercial bank to total assets of the banking system. Then liquidity, we looked at the liquid assets of a given bank as a ratio of total assets of that same bank. For capitalization, we looked at the capital plus the reserves of a given bank as a proportion of total assets of that same bank. And from that, we estimated this model, and we say the bank loan supply depends on the lag effect of the supply of loans, the monetary policy stance or indicator, GDP as a proxy for economic activity, inflation rate, and X, this other variable. This works, okay. Okay. That variable represents the bank-specific characteristics. It's a matrix of the bank, characteristics of size, capitalization, and liquidity. Then the following term is the interaction factor between the monetary policy indicator and the bank characteristics. Then the error term. The mu is the bank-specific error term, and the other one is the overall error term in the model.
Where's the pointer?
Based on that model, we used the general method of moments developed by Arellano in 1991, and later extended by Blundell and Bond in 1998. This extension by Blundell and Bond in 1998 takes care of potential biases because it includes a lagged variable of a lag of a dependent variable. In this case, it will be the loan supply. So we shall not have issues of biases or endogeneity issues. Now, about the instruments, we conducted the Hansen tests, and we tested for serial correlation among the error terms. This is a summary of the results we got. The macroeconomic variables, we have that 91 Treasury bill rate, we have the GDP and inflation. In this case, the 91 TB rate was the monetary policy indicator. It happens to be negatively and significantly related to the loan supply, which is true in literature. A tight monetary policy will result in a reduction in loan supply. Then, similar to the lagged 91 TB rate, so there is some persistence of monetary policy shocks in the economy. Then, GDP doesn't seem to be significant. However, inflation, the lag of inflation is significant and negative because of the actions of the central bank in response to inflation rates. For the bank's characteristics, liquidity is positive and significant, as well as capitalization. However, size is not significant. This implies that, liquidity of the bank and its capitalization are very important in determining monetary policy transmission through the bank lending channel. I've already talked about this. So in conclusion, our results indicate presence of the bank lending channel in Uganda, and the bank characteristics, including liquidity and capitalization, they influence bank loan supply. That ends my presentation. Thank you.
Dorothy, so thank you very much for your presentation. I also very much enjoyed reading your paper. I think it is very good. It is what I particularly liked about it is that you had a very rich data set. So this bank by bank data set over 13 years, I think that you have, is really is unique for basically all the commercial banks that exist in Uganda. And so I think having such a data set is really is extremely important, because only with this type of disaggregated data can you really get into the heart of the transmission mechanism of monetary policy. And particularly in a low-income country like Uganda or Mauritania, I mean, there is some uncertainty to how effective this channel really is. So I think this, with having this data set and looking at this question more carefully, it is really like it is a very important step. Of course, now I'm in the difficult position to comment or to give thoughts on your paper, which basically reads exactly the opposite conclusion to the one that I just presented, even though some of these characteristics of the banking sectors sound relatively similar. So there is high concentration. I mean, you talk about concentration among banks, but I wouldn't be surprised if there's also high concentration in banks' loan portfolio. The credit penetration in the economy is relatively low, so the private sector credit to GDP is less even than the sub-Saharan average. It's less than 20%. Also, you talk in your paper about high interest rate margins. So these are all sort of like characteristics where if I hear about them, then I would start thinking, oh wow, so these banks may not be very or they may not be large or a lot of competition in the sector. So maybe monetary policy would have a harder time getting traction. So I totally appreciate the approach that you've taken, GMM. That's I mean, there are many papers out there who do that. But just on the empirical strategy, I probably have just two thoughts, or I would have two suggestions of things that you may want to explore. So as your monetary policy indicator, you use the 91-day T-bill rate. and that may be the correct indicator, but it may also, in a country like Uganda, be actually more reflecting of the fiscal policy stance. So say if fiscal policy turns expansionary, then also because maybe the policymakers already know that the recession is coming or there has been an external shock, so interest rates go up, then you also see a reaction in banks' loan portfolios. But then it's the question: I think what I would encourage you to do is just to be like sort of to explore like the idea behind using the T-bill rate as the monetary policy indicator in a bit more detail. Because it may well be that it is the correct indicator, but just because it is also influenced by fiscal policy, I think we have to be like a bit this is really a topic where it's worthwhile to spend a bit more time on. And then on my second comment would be that yes, GMM, I mean panels are widely used. However, in my experience, they can also be a bit of a black box. So the coefficients, the significance, they can change dramatically of how exactly you specify the instrument block, the GMM block, how many legs you use, and which variable enter which block. So I would just also encourage you to maybe give the reader a bit more background about all the models you have probably run, because in the paper you basically present your benchmark specification. But then it would also be helpful for comparison purposes to show just the OLS and the fixed effect. Because usually the GMM should be somewhere in the middle, and so this is also a nice way to see whether sort of the empirical strategy sits or broadly makes sense. So these are just two suggestions that I would have. But again, thank you so much for your presentation. And as I said, I think this disaggregated bank by bank data set is really quite exciting. So thank you very much.
Okay. One.
So am I right in thinking that you're using the level of the interest rate in your regression? Sorry? Am I right in thinking that you're using the level of the 91-day T-bill rate in your regression rather than the change in that variable? Sorry? You're using the change?
You can take note. Take note. Not take it note. Later you answer.
Okay, so just to be sure, assuming that the 91 T-bill rate is the right measure of the stance of monetary policy, then the interesting coefficient in this sort of regression is that of the interaction between the bank level characteristics and the change in the interest rate to find out how this changes in monetary policy stance affect different banks differently depending on how strong or how weak they are. So it's the change in the 91-day T-bill rate and the change in the amount of lending interacted with the level of bank characteristics which should matter here.
Okay.
Thank you. I have to say that I like your results very much because they coincide with the study we did for Kenya, similar conclusions. We also have a data set for a similar period. But one issue that we needed to address is that although it is very good to have such a data sample for such a long period, it's also true that in the period there are many changes in the banking system. For example, in the case of Kenya, there was a period of crisis that resulted in changes in the different ratios that you use for your estimation. I was curious about how did you handle that? And the other question is, you mentioned in your motivation that there is a difference of the credit channel depending on the size of the banks. I wonder if you did any regression splitting the sample into large and small banks, and if you have any preliminary conclusion on that.
Okay. Just to add Armando's comment, I think there were also changes in the monetary policy regime during that period, which would change the transmission mechanism. But I also wondered, I think you're asking you're extracting a lot of information from a short time series, but I can't help ask whether you tested to see if you could find asymmetry in the reaction of the lending rate to the policy shock, because I know there's a lot of worry right now about that question. the second question was whether you can find asymmetry in the response of the lending rate to the policy shock, so that the lending quantity, to the policy shock, so that it would work differently when you raise tighten policy than when you lose.
Okay, you can respond.
Thank you very much for the questions. Thank you, Robert, for identifying these two key important issues about the 91 TB rate as the monetary policy indicator. Yes, over the sample period, the Central Bank of Uganda has been using this as a purely monetary policy instrument until recently in 2012-13, when it started using it for fiscal purposes. So for the study period, it's a pure monetary policy. Then for the GMM, I didn't mention it in the presentation, but we used both one step and second step, two-step GMM estimation, just to take care of the identification issues and also validity of the instruments used. Then we disaggregated the block of instruments and used small samples based on weights. Yep. Then regarding the interaction factor, I may not have shown it in the PowerPoint presentation, but it's actually significant, the interaction factor, if I got the question right. The interaction factor between the monetary policy variable and the bank characteristics, is that what you're asking? It's actually significant, and yeah, basically that. Then we try to include a dummy to capture the structure changes in the monetary policy stance, because we changed to the IT light during the study period from the reserve money program. We have not shown the results, but actually there was not significant relationship. The dummy was actually not significant. Then there was a question about the size of the bank, whether small or big banks. We had that variable, that characteristic of the bank's size, in regards to size, which captured whether a bank is big or small. However, it was not significant. It's only the liquidity and the capitalization that were significant. But in most cases, highly liquid banks and highly capitalized banks are in most cases big banks. Thank you.
What is it?
Good morning once more. I thank everybody for attending the session. It is a pleasure to be here and to present this research, which is about bank lending channel of monetary policy transmission and economic development in West African Economic and Monetary Union, a Bayesian dynamic stochastic general equilibrium model approach. For this presentation, I shall argue on the following outline. I will state the motivation and the related literature of the research. Then I will talk about the methodology, data, and the estimation method. After that, I will present the main result of the estimated model. I will end with conclusion and policy implication. I start by this key question. Why do research on bank lending channel is relevant in West African Economic and Monetary Union? Well, for two main reasons. Firstly, because of the features of financial system in West African and Economic Monetary Union, and also because of the magnitude of banking sector in the West African and Economic Monetary Union. Looking more closely to the feature of financial system in West African and Economic Union, we can observe that the regional stock market with low capitalization remains a marginal source of funding for a large number of banks. There is an absence of a secondary market for government securities. The regional equity market remains shallow with only 37 listed companies in early 2013. The interbank market development is limited. There is weakness of the payment system and a limited capital mobility. This underdevelopment of financial system in West African Economic and Monetary Union concerns most channels of monetary policy transmission. Basically, as you see in the chart, the head cost indicate the constraints of monetary transmission channel by the weakness of the financial system. If you look at the first channel, the interest rate channel, the interest rate channel transmission function is hampered by the limited development of the interbank market and the absence of a secondary market for government and securities. That's the head cost. The second channel, the asset price channel function is impeded by the shallowness of the equities market. The third channel, the exchange rate channel effectiveness is affected by the limited capital mobility in the West African Economic Monetary Union, and also by the fixed exchange rate framework in the Monetary Union. And the last channel, the balance sheet channel, is limited by the stock exchange, the underdevelopment of the stock exchange in the West African and Economic Union. However, the banking sector is the most prominent part of the financial system in the West African and Economic Monetary Union. The banking sector holds more than 90% of the financial system assets. There is a substantial increase of the bank credit to the economy nowadays, and the banking system is liquid and well capitalized. Moreover, the compliance with prudential norms remain improved in West African Economic Monetary Union nowadays. As a result, the bank lending channel of monetary transmission appear to be more effective than further channels in West African and Economic Monetary Union. Concerning the related literature, this paper complements research paper on monetary transmission mechanism and dynamic stochastic general equilibrium model in low-income countries. Beyond Berg and collaborator 2013, Ms. Ha and collaborator 2012, we did an empirical investigation of monetary transmission mechanism by focusing in the bank lending channel. Beyond Abradu Otto, Lawrence, Dorothy, Cheng, Sasega, Lungu, Ngalawa, Mugume, Davodi, and collaborators, we use a small open economic dynamic stochastic general equilibrium model to provide empirical results on monetary transmission mechanism in Africa. Beyond Adebiyi Amordi 2010 and 2012, O'Connell and Lang 2010, Arrojo and Collaborator 2013, we introduced financial sector into our dynamic stochastic general equilibrium model for monetary policy analysis in Africa. And recently, beyond Badaron Lefieuge in France and Sangari 2013, we featured a financial contract by adding additional sources of funding and also disaggregating lending, saving, and borrowing funds. Actually, the methodology of this paper is based on the dynamic stochastic general equilibrium model with financial sector in WAEMU. The model encompasses 6 economic agents, namely
Continue. Press this.
The model encompasses 6 economic agents, namely household, producer, government, banks, commercial banks, retailer, capital producer, central bank, and rest of the world. The household receives wages from producer and profits from retailers and use them for consumption and saving. The household have two saving opportunities. They can opt for security invested in domestic currency. They can also opt for security invested in foreign currency. The producer borrow from commercial bank to finance the investment project. They receive funds denominated in domestic currency and also funds denominated in foreign currency. The financial sources of the bank are twofold. Bank receive funds for household. They also receive funds from central bank. Retailers purchase wholesale from producer, repackage them, after that send them to household, producer, government, capital producer, and household, producer, government, and capital producer. The central bank applies its monetary policy based on short-term nominal interest rate. And the government finances the public spending using the lump sum tax paid by the households. The capital producer provide capital to producers. This study used quarterly data extracted from International Monetary Fund and World Bank, spanning from the period of 1980 to 2010. And the observed variables are interest rate, consumption price index, consumption, credit to private sector, heat exchange rate, and heat gross domestic product. The estimation method is based on Bayesian method by the means of two software, MATLAB and Dynam. The main result that comes out from this analysis is that, firstly, the analysis of the impulse response function revealed that bank lending channel improves the transmission effect of monetary policy to aggregate demand by first of all contraveiling the negative effect of different shock on aggregate demand, also by amplifying the positive effect of different shock on aggregate demand. Secondly, the analysis of fluctuation of macroeconomic aggregate revealed that foreign shocks, namely supply shocks, determine more than 56% of the fluctuation of inflation in West African Economic Union, while domestic shock, namely supply shock, determine more than 51% of output fluctuation. The analysis of the estimation result revealed that the possibility for the Central Bank of the West African countries, the BCAO, to adjust the policy rule in order to affect the macroeconomic variable using the bank lending channel. Also, the result of estimation revealed a low and incomplete exchange rate pass-through in West African Economic and Monetary Union. As for conclusion, we can say that dynamic stochastic general equilibrium model that considers financial sector perform better in in explaining the macroeconomic variables in West African Economic and Monetary Union. Furthermore, in the presence of the effectiveness of bank-lending channel in West African Economic and Monetary Union, monetary policies still seem to have a significant impact on economic development. And for policy implication, we can say that given the banking sector prominence feature in West African Economic and Monetary Union, further financial depth and further financial systems are needed to facilitate the financing of growth and improve financial inclusion. Also, policy makers in WAEMU in their process to resolve macroeconomic instability in order to achieve some economic development should adopt structural reforms able to absorb different types of shocks, namely surplus of both foreign and domestic. Thank you.
Okay. Let me congratulate you for the work well done. Actually, to venture into DSGE, Dynamic Stochastic General Equilibrium Model, is a technical area. And in fact, it used less than 10 minutes to make the presentation. I hope if you have read the paper, you know that he has done a lot of work in that particular paper. And we know that DSGE is very complex when it comes to computational cost. And also now the big aspect of it now is that we have software, as he mentioned, that can help us to do the estimation with each. And the paper actually examined the banking lending channel, WAEMU, and also find out that in West Africa Economic and Monetary Union, it made use of small open economy with the oligopolistic banking sector and fiat regime. And the result lend credence to claim of financial DSGE explaining macroeconomic variable better, and also gave the recommendation. As I said, let me first of all talk about the general issue about DSGE. There are issues related to stock and flow variable. When one makes use of real business cycle and new Keynesian approach model. For real business cycle model, we are talking of stock. It's emphasis on stock. And when you are modeling, you have to bear this in mind. And when new Keynesian policy model emphasize flow, and thus there will be need nowadays to combine both stock and flow variable together, particularly when it comes to estimation. And these are one of the challenges which I'm sure you are likely to face in the course of carrying out your work. And another general challenge that we can also identify is this issue of data. DSGE model philosophy assumes that there is steady state in the economy, and that it implies that all ratios of certain variables are constant. But in reality, it might not be so, particularly in one country. The question is, how were you able to address this particular issue? It's a challenge which I'm sure you face. Then let me come now to specific issue on the topics. Yes, you work on banking lending channel, but nothing was said about economic development or WAEMU. Therefore, I think the topics will be refreshed and let you read bank lending channel of monetary policy transfer and WAEMU, a DSGE modeling approach. That would be a better topic rather than indicating economic development when actually you did not work on development. Now, another specific issue on methodology. I think if you are able to read the paper, you discover that the framework alone covers 25 pages, whereas the empirical and all others, including cover just 12 pages. I think you need to refocus more on the findings and less on framework, because the techniques are there. And also in linearizing your equation, there was nothing done in that particular aspect, and it's quite difficult for one to follow the paper when it comes to linearize. And if you read the work related to Taylor approximation rule, it will help you in that particular regards. And you make use of Bayesian techniques nothing was said about Bayesian techniques, and I think you have said something about Bayesian techniques, how the prior, the likelihood, and this were arrived at. It's very important that you also look at that. Now, coming to the calibration of the prior, the questions I have for you, which I think is also very important, is what are the basis for this prior? To what extent did these priors reflect the characteristics of economy of these countries in question? Are these prior beliefs actually obtained from, how did you arrive then? Past experience? Did you consider the model of economy have similar characteristics with you? What of the validity of economic theories? How did you take note of that? What of the opinion of experts in that aspect? Because DSGE is a complex, and just deciding on prior is not an easy task. It's very complex. But just we see the result beautiful, we know that many things must have gone to root. What of the stylized part about the economy in question and the existing empirical literature? All these are very key when it comes to the selection of your prior. There are another specific issues, how you match your model with data. These are 4 questions that you must answer, particularly when you are asked to know whether the model is actually behaving well. The variable in the model actually co-trend. The variable that I1 actually co-integrate. Are the dynamic response consistent with data, and so on and so forth. Because failure to do this, to answer this question, will mean that forecasts made with this model are being attracted to the wrong point at the horizon lengthened. And also, in your empirical, it's also good to indicate, to show this univariate and multivariate multi-colors Markov chain diagnostic test. You have to include that. It's very important. And also, the graphic representation of the prior and the posterior is also very good. They have to be included in that particular study. On the final note, yes, Africa is a very unique country. And when you are using DSGE, you have to take to consider the peculiarity of our economy. And when you come to Africa, the Africa is characterized generally by informal sector. How are you able to address this? What of the formal sector is dominated by public sector? Take, for instance, in my country, and I'm sure in most of the WAEMU countries, public sector. Then, and also we talk of rain-dependent agriculture is a large share of GDP in most of African countries, and imperfect traded food constitute a large portion of this. All this must be embedded in your model before you can apply DSGE to address the issue of the country in question. And I think we did little comment. If we take that into consideration, it will improve the work. Thank you. I think we should give room for question and answer. Question? To him, not to me. Okay.
Hi, so my name is Rafael Portillo from the IMF. I had a couple of questions for Thiery. Which I thought the paper was very interesting as far as I can tell from the presentation. One question I had is regarding the modeling of monetary policy in your model. WAEMU clearly is a monetary union peg to the euro. I'm sure there's some scope for monetary policy given that there's limited capital mobility. But how did you address the issue of the monetary union? Did you keep track of that? Did you keep track of reserves, say the reserve position of the central bank trying to defend the peg? Or did you just assume more the traditional setup of there being a flexible exchange rate and complete autonomy, monetary policy autonomy? And the other question I had for you is, you were emphasizing the lending channel. I assume, you didn't talk about this, but I assume you had some type of financial accelerator in your model. And there, the question I had is whether you were keeping track of various rates in the financial system, say short-term rates and lending rates, as a way of characterizing movements in the premia in the financial system, say perhaps driven by the financial accelerator or shocks within the banking system, or whether when your estimation was the lending rate sort of an unobserved variable. Obviously these things matter. But otherwise I thought that was a very interesting application.
Okay. Okay, you can respond. You are lucky. If you have, or you don't.
Okay, thank you, Rafael, for the sound question. Concerning the monetary policy union, you're right, we didn't base the analysis of centered on the reserve of money program. We did use the monetary policy, the interest rate. It is one of the shortcomings of the paper, because if you want to effectively capture the behavior of the central bank in WAEMU, you have to base on the reserve of money program. You know that, but since we wanted to focus on the financial relation between the banking sector, the household, and the producer, we didn't want to inlet the model. So we assumed a minor hold to the monetary authority just to fix the interest rates, to allow the bank to refinance to the central bank, and also receive money from the household and finance the investment project of the producer. We didn't rely on a reserve of money program. The second question, did the financial sector operate in this model? Exactly, the financial sector operate in the model. When you saw the first result, the impulse response shock, there is one of the two of the full shock. I clearly state in the paper how the financial sector operates in the model. That's why I said that that's why I emphasize when I present the result, the whole of the bank lending channel, because it depends on the shock. When the shock is negative, the bank lending channel can prevent a negative effect, and when the shock using by means of the financial accelerator mechanism. And when the shock is it has a positive effect on aggregate demand, the bank lending, the financial accelerator mechanism permits the response of the shock to amplify the positive effect on output and investment. Thus, the financial sector operates into the model.
So thank you. Let's move to the last section so that we have time for other things. So I happen to be the last presenter, my humble self, Mike, Adebayo, and my colleagues is unavoidably absent. Today is our MPC meetings, monetary policy meeting at the Central Bank of Nigeria. So one of us has to be there. That's why he could not attend this conference. That is the topic, and that's the outline. We are trying to look at this paper from the perspective of this outline, introduction, objective, the framework, Nigeria, looking at the theoretical underpinning, review of the empirical literature, analytical framework, empirical research, summary, and conclusion. Yeah, that's the view of Alan Greenspan. Very important that implicit in any monetary policy action is an expectation of how the future will unfold, and that is forecast. A lot of work has been done in the area of VAR and the monetary policy transmission mechanism. There's no doubt about that, a lot. But one thing we observe from all these studies that most of the VAR studies are limited. They have limited information set. Apart from that, when it comes to monetary policy decision, they are of little help. And in fact, the issue of price pursuit is very common with VAR. And in reality, central banks all over the world needs to monitor large volume of economic data and indicator to inform policies. Such decision process can only be achieved, for example, using a factor augmented VAR model. And these studies is emphasizing this because of the importance of VAR. FAVAR is data-rich techniques. They are data-rich techniques. They help to observe and summarize large number of time series information using comparatively small number of probable factors. This VAR we are talking about has explored by many other studies. I just mentioned few. If you have theirs, when you pick the paper, you see other studies, those who have done the country where it is done, and all these studies provide high information content for policy making. But unfortunately, Nigeria not yet on Nigeria, and that's the motivation for this particular study. So these studies analyze reaction of different prices. The emphasis is on the component of CPI, Consumer Price Index in Nigeria, to interest and exchange rate shock. And the paper further identify factors that affect the variation in these responses. I also try to look at the framework as the background of monetary policy in Nigeria. Between 1959 to 92, we have direct monetary framework, and 93 to date, we have indirect monetary framework. And in between, we also experience, we target exchange rate between 1950, we targeted exchange rate between 1959 and 1973, and between 1974 to date, we have what we call monetary policy targeting. Direct monetary controls to be abandoned due to inherent inefficiencies, and they have to be abandoned and move towards a better liberalized and deregulated policy precisely in 1993. Bank adopt new monetary policy framework, call it new, not new, that's why in 2006, they tried to seek from a quantitative now to price target, introducing interest rate corridor with standing and deficit facility rate around monetary policy rate. We have the monetary policy rate now is the nominal anchor. And the new framework emphasizes third time rate as the operating target. I tried to put this slide to tell us, as of January 24, the MPC met, and the reason why I put it is to tell us where we are. The Monetary Policy Committee agreed, January 24, 2014, that to retain monetary policy rate at 12% with symmetric corridor of 200 basis points. They also agreed to retain CRR, cash reserve requirement, at 12% for public sector deposit. Here is an issue. They raised cash reserve requirement for government sector deposit from 50% to 75%, because it was discovered that the bank, the deposit money bank, attack banking sector through this approach, because they have free funds of government with them, and they use those funds to attack the market by using to buy treasury bills, and therefore causing volatility in the foreign exchange, volatility in the foreign exchange market. They also retain minimum liquidity ratio at 30%, retained net open position at 1%. All this, the essence of all this is to curb excess liquidity in the banking system, eliminate large volatility in the interbank core rate, and not to engender efficiency in the liquidity management and encourage interbank trading. That's the rationale for taking all these decisions in January 2014. And because of the policy, different type of policy decisions that are taken, this has been the trend in the headline inflation in Nigeria. And you see toward the tail end of from 2011, 12, 13, you can see inflation has been reduced to 1 digit. That's the big achievement during the monetary policy target. So also look, this is the average inflation rate for the period. This is the growth rate. The growth rate is in the neighborhood of around 7.6%, above 6% now. And also the outcome and the target and outcome inflation rate. We are trying to now target the outcome and target are very, very close as a sort of policy, but also look at the outcome and target for the GDP, for the exchange rate. You can see the problem here. The reason is because of the strict monetary policy. It's difficult because the essence of central bank has to monitor, has to ensure price stability, and as a result of that, they have to increase monetary policy rate. Throughout 2013, monetary policy rate was 12, retained at 12. The essence was to curb this excess liquidity in the economy, and that has impact on the lending potential of the deposit money bank, and that's why the deviation of target from the outcome, or the outcome from the target. Similarly for money supply and also the interbank rate. These are some of the challenges we face, but the most important challenge is this unwholesome practices by authorized dealers, bureau de change in the foreign exchange market. These are the problem, and it's affecting the exchange rate, volatility, and central bank intervene regularly in the market to ensure that the exchange rate is within the band. That's I think the role. Now the data. We have 84 variables covering 2000 to 2013, classified into 36 fast-moving and 48 slow-moving variables. Then we have components of we have 12 components of CPI. Then interest rate, we also have 10 money market indicators, 12 monetary aggregate, DNB credit on 8 loan subcategories, capital market indicator on Nigeria Stock Exchange OCI index, real GDP on 17 activity group, industrial production indices on 4 sectors. These are the variables included. Altogether, we have 84 of them for this period. And the sources are from National Bureau of Statistics and the Central Bank of Nigeria. That is technique. And this technique is trying to consider the relationship between the observed Y and the unobserved F. These are defined in the transition equation given above. And the Y is M times X vector. It's an observable economic variable in that particular equation, and it's assumed to influence the underlying change in the economy and includes a policy variable. The policy variable is monetary policy rate, and the observable variable of real and prices, which I've indicated. And also, the model incorporates the unobservable variable, and they provide additional information that is not captured by Y. The unobservable variable reflects the potential output, price pressure, credit condition, and so on and so forth. And now we are trying now to say, if you assume a large set of N information times series X, where K plus M is less than N, is related to the observable F and observable variable Y, then we can specify the observable equation as this. And we also discovered that the Stock and Weinstein 2012 excluded the observable from it, and they focused on unobservable, and now try to tell us that in the static form of the dynamic model, X is influenced only contemporaneously by the unobservable variable F, since we assume K plus Y is less than N. The amount of information utilized in FAVAR is much higher related to typical VAR. That's the essence of using a VAR. Now, coming to the empirical result. Here we are trying to identify what we call principal components. About 10 of we pick the first 10 principal components, and we try now to look at the proportion of the first principal component. For example, the first principal component, the first two, accounted for 33.6% of the variation in the data space, while when you move down to the first 5, it accounts for 60.2%. And note, from this, we know that a small number of the principal components explain larger cumulative proportion of the variance in this group. Then coming now to the correlation between principal components and the key variable, we classify them into the first variable CPI components, another variable we classify into first, second, and third. because of the importance of the contribution of this component. And we now try to identify what is the correlation between these principal components and the key variable. We now discover that for the first principal component tends to describe the real variable better, particularly in the area of output, while the second and third explain the nominal variable perfectly. For what we discover is that there is no perfect certain between variable or group of variable and the factor that may make them closely. There's no certain. And now we try now to look at the sensitivity of each of these variables to shock to monetary policy rate. And by computing the R squared for the first principal component, second, third, for the 13 component, for the 12 components of CPI in Nigeria and the headline CPI. And also we did the same. We did the same for we did the same when exchange rate is shocked. And what we observe generally from that two tables, one, the table shows income variability in the value of R squared among the components of CPI and the first 3 principal components. We discovered that common factor explains about 16% of the variability of the headline CPI when MPR is shocked, and 11% when exchange rate is shocked. We also discovered that which is more higher than some of its components. Reason because headline CPI reflects macroeconomic conditions, while its components are influenced by changes in relative prices. We also discovered from that table that transport, clothing, footwear, housing, and others are significantly affected by the common factor, but food, beverages, tobacco, and cola nuts are not significantly explained by the common factor. And the reasons, we now went further now to look at the import response. When monetary policy rate was shocked, we now tried to look at how this 13 component or 12 component responded when monetary policy rate was shocked. And the findings there is that 7 out of the 13 components of CPI basket declined. The impact is more significant in housing, water, electricity, gas, and other fuel than other components. That's what we are seeing here. That's the impact. Housing, water, electricity, they have the highest impact, followed by transport. Then we also discovered that both restaurant, housing, headline CPI, college, beverages, and scholar, all these rows has it's like there's element of price pursuit in that particular study. Then we also discover when exchange rate is shocked, we also look at the impact. And what we observe is that when exchange rate is shocked, number one, the effect of exchange rate to food and non-alcoholic beverages is negative. Reason due to the fact that food CPI is supply driven in Nigeria and depends significantly on agricultural produce. Climate weather increases food production and consequently reduces food inflation. The proportion of food in the CPI basket in Nigeria is 51.8%. It's very high. Consequently, the negative impact of exchange rate on headline CPI is a reflection of large proportion of food in the CPI. Out of 13 components in the CPI basket, 7 respond positively to an unanticipated shock to exchange rate. These are the variables that respond. And what we discovered there is that housing, water, electricity, gas, and other fuel show the highest response. That's what you see here, has highest response. And what the implication? The implication we are seeing from the result also from the implication that exchange rate pass-through to price in housing, water, electricity, gas, and other fuel is 0.024 in quarter 4 and 0.037 in quarter 8. We now identify that there's a link between housing, water, electricity, gas, and other fuel and exchange rate in Nigeria. Thus, exchange rate pass-through to price in Nigeria is an important mechanism in the housing, water, electricity, and gas, and other fuel sector, among others. And the exchange rate is a significant channel through which monetary policy transfers to price in the short run. The conclusion now is that, one, there's a strong link between housing and transport sectors, as I've said in the study, and the exchange rate pass-through is also an important mechanism, as I said, and exchange rate is a significant conduit through which monetary policy transfers to price in Nigeria. Thank you.
Thank you, Adebayo, for your great presentation. My comment will rely on three major points: the overview of the paper, the research background, and the suggestion. The main idea of this paper of Adebayo and Mauritania is twofold. On the one hand, the paper assesses the reaction of the component of consumption price index to different shocks. In the other linking, the paper endeavors to identify the factors that a certain direction or extent of the response of the consumption price index component. The empirical relevance of the paper is the use of the factor augmented vector autoregressive model to address this important issue. The paper is topical and potentially policy relevant because it meets the challenges faced by the Central Bank of Nigeria to improve the performance of monetary policy and notably the price stability. By the way, the paper grounds its analytic contribution on 4 key hypotheses. The whole analysis is based on a well-proven hypothesis that monetary policy shocks are critical for short-term price stability, as well as other key macroeconomic variable stability. Secondly, the monetary policy transmission mechanism mainly operates in Nigeria through monetary policy rate channel and exchange rate channel. 3. The price puzzle phenomenon contravenes the ability of the standard vector autoregressive model to completely assess the effect of monetary policy on macroeconomic variables such as prices. And finally, the large-scale nature of macroeconomic model with full information set provide relevant empirical results for policymakers concerning the monetary policy analysis in Nigeria. The last point of my comment concerns shortcomings and suggestions. First, even if the paper of Adebayo and Mauritania succeed to analyze the reaction of the component of consumption price index and the headline CPI, the paper didn't clearly state the factor that determine the direction and extent of the response in Nigeria. Secondly, the paper justified the choice of the factor augmented vector autoregressive model by the necessity to avoid the price puzzle, least by the insufficient information set in the vector autoregressive model. Paradoxically, after using the factor augmented vector autoregressive model in the study, the result revealed the existence of price puzzle in Nigeria. How this occurs once more, it is not explained. What will be key in determining the relevance of the model in this study? And my last comment. The paper does not place a great emphasis explaining why only the factor model equation has been estimated without incorporating observable variable. The author should have estimated both equations with observable variable equation 2 in the paper and without observable variable equation 3 in the paper in order to highlight the robustness of common factor in the development of specific variable and make difference between the two equations. Thank you.
Okay.
Thank you very much for your presentation.
Okay, sir.
I have a few questions. Firstly, you commented that through the NPR, the CBN has been successful in keeping the inflation rate low. From my experience, anecdotally, the Nigerian inflation rate has not been tamed. So I'm curious as to how you're so sure that that rate is accurate, because in the marketplace, we don't see the rate of inflation being steady. Okay. My second point is you comment about the recent move in January by the CBN to increase the CRR for public funds by the banks to prevent them speculating in the foreign exchange market. Why has the Nigerian bank not contemplated completely liberalizing the exchange rate? Because they've been unsuccessful in managing it. They keep on intervening, they keep on raising the bands, but over the long term, they've been, in my opinion, unsuccessful. And then finally, in your conclusion, you say that housing and transport, there's a pass-through from the exchange rate to housing and transport. that's what your study shows. Could you comment on the intuition behind that? Because I can't fundamentally see why the exchange will impact upon housing and transport in particular. So I'd like to know some fundamental reasons why that happens to justify or to explain why your findings make common sense at the basis. Thank you.
I have it may not be a very smart question because I'm not an expert in this, but I'll ask it anyway. In terms of looking at the effect of NPR shocks, I know I read a very good paper, a very famous paper when I was in grad school, about why just using the changes in NPR is not a good measure, because changes in NPR are a response to prices themselves. And the paper used surprise changes, that's changes that were unexpected. And it's not exactly clear what you use here. So I'm wondering, did you just use changes in NPR, or is it possible to look at surprise changes in NPR that are unexpected to use to measure the effect?
My question, you talked about the shocks that you applied to two measures, exchange rates and the monetary policy rate. But the NPR was last changed, if my memory is correct, in October 2011. And since then, the measures that have been taken have been rather unconventional. Example, raising the public sector deposit CRR, and some will argue that that has been more effective in controlling the inflation rate, because it's been on a decline since then to 7.7%, I think, in February. So my question then is, even though the time series is short, since it was only relatively recent that it was applied, could you perhaps, or did you perhaps, check for the effect of such measures, maybe shock that particular variable in itself, and maybe get some answers as to which is more effective with respect to monetary policy transmission? The NPR, that's NPR shocks, or shocks to the public sector CRR?
Okay.
Thank you. Just to follow up in a way on a couple of last comments, I'd like to see, maybe I have to read the paper, but I'd like to see more reflection on indeed the exchange rate regime and how that interacts with the monetary policy shock. Should we interpret these exchange rate movements as separate shocks to the exchange rate? Are they, for example, risk premium shocks? Is monetary policy responding to those shocks, or is the exchange rate responding to monetary policy? Is it really a separate issue? And in a way, this comment applies actually to two of the other papers. It does seem to me that where the exchange rate is heavily managed or fixed, we have to think differently about monetary policy. For example, inflation in a fixed exchange rate is actually also the real exchange rate. So when we start to ask, if we ask ourselves the question, how does monetary policy affect the real exchange rate, we start to think differently, I think, than if we are in a different exchange rate regime context. Thanks.
Okay, let me address this. Probably we can have another round of questions. Let me just try my best. Okay. Oh, okay, thank you. Okay, let me thank you all for your input. The purpose of all this is to further enrich the paper. And let me start by asking the question, why, the last question, let me start from that. MP asked why it is since 2011 is stable, and why not try public sector CRR? I think it's an information which I think we will also apply. Actually, this study is, and we extracted this paper from the larger FAVAR model that we built for the bank. And the rationale behind this is that let's identify the components of CPI and see how MPR has impacted on them. And in the larger paper, we also consider the public sector CRR as shock. We also consider as a policy variable and the impact on the various components of CPI and other macroeconomic variables were considered. But we also go back and see, because I may not be able to come out with the exact the impact of that public sector CRR now. But we have done that, but we still see how we are going to revisit it and see which one is more important. Then the question on monetary policy rate, did you have them at level or at change? Yes, it's monetary policy rate is at level, not change. We didn't include that change. It's like when in the model, as you said, arrange the variable, slow variable, then fast variable. The last column is the monetary policy rate. And when you shock it, how it affects the fast variable will respond first, while the slow variable will respond with lag. So the MPR is at level, not change. We use MPR as change. Then the issue on exchange rate, why not liberalize? Yes, and also why inflation rate was low. You see, in Nigeria, one has to be very careful when it comes to exchange rate liberalization. And you have to consider your economy in question, particularly in Central Bank of Nigeria. I showed you that we operate monetary targeting. We are not operating exchange rate targeting. And regularly we intervene at foreign exchange market to ensure that the exchange rate is within the band. Currently, the band is 155 naira to $1, plus or minus 3, meaning now that we won't allow the exchange rate to go beyond 158 and 152 or 152. That's the band. So anytime the exchange rate go beyond that, the bank will intervene by selling foreign exchange so as to cushion the effect and to liberalize. That has been the policy, and that has been the factor that make the exchange rate to be stable for some time. And for the inflation, the exchange rate, the monetary policy rate, yes, throughout the year, throughout 2013, monetary policy rate was 12%. And that the CRR, I told you that precisely last year, October, Monetary Policy Authority had to introduce cash reserve requirement in the public sector deposit. Before, it was uniform, 12%, it was 12%. The government had to introduce public sector deposit because banks keep public sector deposit and now use the money, free money, to attack the to buy treasury bill in the foreign, to buy the foreign exchange, thereby creating volatility. And also, we need to understand the nature of Nigerian economy. Normally, all the proceeds from the crude oil have to be shared. That's the policy, the excess crude oil account, that at the end of the month, the government and the state government, they distribute this particular money. And the impact of the economy is very much, particularly at that particular period. When the money is shared, there will be more money in the economy, and that was the problem with volatility in the interbank rate. And monetary authority has to intervene regularly, and by introducing a public sector deposit and increasing it from 50 to 70, we try now to cripple, to hinder, to reduce the ability of the deposit money bank to intervene in the market. And in fact, I'm sure probably they are meeting right now as I'm talking, they may likely increase the public sector deposit from 75 now to 100, meaning now that the bank will be forced to look for funds among themselves rather than using cheap government money to attack the market. That has been the policy, and that has helped us to bring the inflation to low digit, to 1 digit. And you can see from what I presented, the credit to the private sector, the output and the target and the outcome, you can see the variation is because of the tight monetary policy. The banking sector find it difficult to lend because they discover that they have to look for funds among themselves. They have to mobilize funds outside the bank, and that should be that's how it should be. Is to encourage interbank lending. But in Nigeria, we don't know why banks don't want to lend among themselves. They want to borrow among themselves. They prefer to use free government money, and that's what we try to avoid. For monetary policy transition mechanics to be effective, there should be interbank rate, that banks should lend among themselves, and that's what we are trying to do so far. Don't know, maybe if there's other one I've not.
To housing and transportation. That's your main finding.
Okay. Yes. Well, we can also consider the economic theory. Housing, for example, building and raw material. They have to pass through. You have to import. Most of these have to be imported. And when you are importing all these things, when you want to import these things, is the exchange rate. You pass through the exchange rate. And I think probably that might be the reason why it has impact in Nigeria. And also, probably another reason which I may think, in Nigeria, you've discovered that because of the fact that the government official, few government officials, because of the level of activity, they have access to funds directly or indirectly. Some of these things tag or tie this money into building, into real estate. Now, the possibility of carry money abroad has been reduced, and therefore, the only alternative probably is to now sink this money into housing. Because if I've been to Abuja now, and the type of structure there, you marvel. In fact, here, I think probably because of importance of this, that might be one of the reasons why the exchange rate has been impacted on housing and other things. But probably you will have better answer to explain. You are welcome. So, maybe do you still have a question? Or if not, on that note, we say thank you for your comments, and you are welcome. I'm tired.
Sorry, since there were a few minutes left in the session, I thought perhaps I could add a comment. I thought I really liked your use of the factor model to summarize information in a lot of data and characterize the co-movement in the data. And I think there's a lot of benefit of doing that everywhere, but also in African countries in which perhaps single variables are very noisy. Yeah. And so this is a way of going past the noisiness of the data to getting something sort of more robust about the state of the economy. So I really like that effort. I thought that perhaps what is a bit trickier is these issues of identification of shocks. And just because you have a factor augmented VAR doesn't mean, those issues are still there. About, inevitably you have to deal with ordering of, whether interest rates respond contemporaneously to some variables and not to others. And in an economy like Nigeria, where clearly exchange rate management issues are important, getting the right identification can be very tricky. And so I think a lot of the questions were in that sense. So perhaps something that you could consider is combine, this just perhaps for future work, combine the way you're characterizing the data in terms of factors with perhaps an alternative approach to getting at monetary policy shocks. And I'm thinking at, for example, event studies. And so you could, if you have in mind, because clearly you're at the central bank, you have a good sense of of what's been happening.
Yeah.
So if you have in mind an episode where it was very clear that the central bank was trying to tighten policy, it's probably hard to argue that it's going to be fully exogenous, but at least if you could trace then the effect of that policy response on your set of variables, including on your factors, then that may also be a way of getting at this question of what the effect of policy is without having to argue endlessly about ordering and what responds to.
Thank you.
Just a suggestion.
Thank you very much. In fact, one of the limitations of FAVAR is what he has identified, this issue of identification and ordering of variable, where you have a large number of the variable sets, close to 200. Then the issue is how do you order, how do you arrange the variable, which one comes first? Even though we said we can classify variable into fast moving and slow moving, but among the slow moving, which one comes first? Among the fast moving variable, which one? These are the issues that FAVAR has not been able to overcome. And also we have other development in the area. Bayesian this structural FAVAR now try to address all this. But with the information you are giving to me, I thank you. I will go back and see how we can use those information to improve the work. Thank you very much. Okay.